All right. Hey, welcome back to Accounting 605, Accounting for Managers here at UMGC. I'm still your professor, Dr. B. Happy to be with all of you today. We made it all the way to week 4, which is awesome. Yeah, great work, everyone, on getting to this point. Believe it or not, the time goes by so fast, and at the end of this week, we'll be halfway through the course. So that's just a testament as to how fast time goes by. So let me go ahead and I'm going to start by sharing my screen, and hopefully you can see the PowerPoint presentation. And so just like we've done over the past few weeks, if you have any questions, comments, or whatever, feel free to unmute your microphone and ask your question. You could also type it into the chat, whatever's easiest for you, okay? And I'll do my absolute best to answer your question. So let's go ahead and jump into the conversation on property, plant, and equipment, also known as PPE, also known as fixed assets, also known as right. There's a lot long-term assets. So there's a couple different names for this. But so what we'll do is first is we'll jump into our presentation. I'll walk you through how fixed assets work. I'll walk you through the various accounts, and I'll talk to you about how depreciation works and all of those things, right, that are related to this week's assignment and to this week's discussion. So let's go ahead and begin that conversation. And the first thing I want to talk about is what are plant assets or fixed assets. So plant assets are tangible in nature. They are um, what we call fixed assets. Plant assets are tangible assets that are used in the company's operations. They have a useful life of more than 1 year. These assets are also called plant and equipment or property, plant, and equipment, um, also known as PPE or fixed assets. For most companies, fixed assets make up the single largest class of assets that the company owns. So when you're looking at your 10K report and you go to your balance sheet, your long-term assets, you're going to find these components. So this is going to be like property, plant, and equipment. And we'll talk a lot more about these. But the idea here is that they're able to provide an expected benefit for the company. Companies use property, plant, and equipment to help the company to generate revenue, right? So in manufacturing, we use equipment, we use the building, we use the land to help the company to generate sales, right? Because we're making products, we're building things, we're mining the earth. These activities are why the company exists in the first place. And so in order to perform these activities, to make a product, we need to have a building, we need to have the equipment, we need to have the land. So so these things help us to generate sales, and that's why we call them assets to the business. So when it comes to these assets, there's a calculation that we use to determine the value of the asset over time. And we do this in 4 steps. The first thing we do is we compute the cost of the acquisition of the asset. And the cost of the acquisition of the asset is not just the purchase price. It also includes the purchase price plus all of the landed costs, what we call landed costs. It's the purchase price plus the cost of installation, plus the cost of testing, etc. The cost of the insurance of transporting the equipment. We add all those together and they become what we call the acquisition cost. So the first thing we do is we compute the acquisition cost. The second thing that we do is we allocate the cost of the uh, plant's asset. In other words, we take that cost, that landed cost, and we allocate it across its useful life, how long we plan to use the asset for, or how long we expect the asset to last, useful life. The third thing we do is we account for the expenditure of that asset. This is where the depreciation comes into play. As an asset is used over time, it loses its usefulness. Think about a building, think about a vehicle, think about equipment. Anything mechanical can and will break down over time. It's just a matter of fact, right? That's just how it works. The components in your vehicle, your car, they break down over time. They're not designed to last forever. That's just the nature of anything mechanical. Because it's mechanical, there's several moving parts. Because there's moving parts, there's going to be friction. And as there's friction, it causes things to break down. That's just how it works. Think about the building that you're in. How many times you open and close the door, open and close the window, etc., etc. Oftentimes we have to go around with a screwdriver and tighten up the screws because the cabinets are opened and closed so much it causes the hinge to wear out. Right? They use their they assets lose their usefulness over time. And in order for us to recognize the loss of the usefulness, we depreciate the asset. And I'm going to show you how all that works. But that's step 3. And the fourth step, at the end of the useful life of the asset, we can continue to use it. It's just not going to have any value. Or we can dispose of it. We can sell it. We can scrap it, etc. I want to record that as well. So that is the 4-step process that we do with all of our fixed assets, except for land. Land is the only thing that does not ever depreciate. And the reason why we don't depreciate land, the physical earth, is because the earth is infinite. Infinite. Meaning earth has infinite useful life. The dirt itself has infinite useful life. I can knock the building down on top of it and put up another one. Right? The land itself is still going to be there. The land itself does not lose usefulness. So that's why we say that land can never depreciate. We'll talk more about that as well. So the acquisition cost, as I had mentioned, it's not just the purchase price. It also includes other expenditures required in order to get that asset ready for use. So the shipping, the assembly, the installation, testing costs, all of these are included in that total cost of acquisition. All the expenses needed to prepare the asset for its intended use and get it ready and all that jazz. All of that together equals the total cost of the acquisition. So it's the purchase price plus assembly, installation, testing, cost of building a base for a machine, installing electrical hookups for a machine, testing the asset before it's put into operation. All of those costs plus the purchase price get added up and equal the total cost of the acquisition of the asset. That ends up being our recorded cost of the asset. It's book value. When it comes to machinery and equipment, these fixed assets, when we add up the total price of these, it's the purchase price plus the installation and assembly and testing, plus transportation charges, plus the insurance while it's in transit, plus any taxes, all of these added up together equal up the total cost of that piece of machinery or that piece of equipment. And so that becomes our book value for that machinery or equipment. When it comes to buildings, a building account consists of the cost of purchasing or constructing the building that is used in the operations of the business. When purchased, the building's cost usually includes its purchase price, taxes, title fees, lawyer fees, etc. The cost also includes all the expenditures that we need in order to get that building ready for use, like repairs and renovations. That's for an existing building. When it comes to constructing a brand new building for use, the costs include materials, labor, indirect overhead costs. Those indirect overhead costs typically include things like heat, lighting, power, depreciation on machinery used to construct the building. Costs of the construction also include things like design fees, building permits, and the insurance used during construction. So those are all the types of fees that we add them all up, equal the total book value of that building. And then we have land. Well, I should say land improvements. The land improvements are additions to the land, but they have limited useful life. So we have the building, and around the building, we got that thing called a parking lot. And that parking lot is what we call a land improvement. So parking lots, driveways, walkways, fences, lighting systems. These are the costs of the land that include the costs necessary to make improvements ready for their intended use. Right? Those types of things, yeah, those depreciate over time. We know that. Every winter, that parking lot takes a bit of a beating from the salt and the ice and the rain and the whatevers. And so the parking lot deteriorates over time. It depreciates in value over time. And so it's something we need to continuously improve. But these land improvements, they're associated with the building. And so oftentimes on your 10K report, you'll see things like that. And then we have the land itself. The land itself, it does never depreciates in value. The surface of the earth has an unlimited life. It's indefinite. Land includes the cost necessary to make it ready for its intended use. When a piece of land is purchased for a building site, its cost includes the amount paid for the land, including any realtor commissions, title insurance fees, legal fees, and any accrued property tax paid by the purchaser. Payments for surveying, clearing, grading, and draining are also included in the cost of the land. Other costs include government assessments, whether incurred at the time of the purchase or later, for items such as public roads, sewers, sidewalks. These assessments are included because they permanently add to the land's value. The cost of removing structures minus amounts recovered through the sale of salvaged materials is charged to the land account. So when you look at your balance sheet for your 10K on your 10K report and you see land, that land value comes from these things. but land is never depreciated. So you'll never see any depreciation associated with land. The depreciation is for the building that sits on the land. Land assets sometimes are purchased in a group or in a single transaction for a lump sum price. When you look at your 10K report, you might see this. This transaction is called a lump sum purchase, or a group or a bulk or a basket purchase. We allocate the cost to the assets acquired based on their relative market or appraised values. These can be estimated by appraisal or by using the tax assessed valuations for the assets. So here we have an example where CarMax paid $90,000 in cash to acquire a group of assets, which included a building and some land. And so that we use the appraised value to allocate the cost for these. So here we see the building had an appraised value of 60,000, the land had an appraised value of 40,000, giving it a total appraised value of 100,000. And so given those amounts, we use the percent of the total in order to apportion the total cost. Now the company only paid 90,000, but the value, appraised value, is 100,000. So obviously we got a deal on this. And so we have to apportion the cost appropriately, and we do that based off of the total appraised value. So in this case, it ended up being a 60-40 split, 60% allocated to the building and 40% allocated to the land. So based off of that, we took the $90,000 that we paid and multiplied that by the respective percentages of the total to be able to apportion the cost. So this is all relative to market value, right? So that's just, I just want you to understand how sometimes a larger company might acquire more than one asset in a single purchase. You'll probably see something like this in the notes to the financial statements on your 10K report when you're looking at those fixed assets. So this kind of gives you a baseline understanding of that. I had mentioned that over time, anything mechanical can and will break down. It loses its useful life. We call that process depreciation. It's depreciating in value because it loses its usefulness over time. Depreciation is the process of allocating the cost of the plant asset to the expense while it's still in use. We're expensing the value out over time. Depreciation does not measure the decline of the asset's market value or its physical deterioration. It only measures the loss of the usefulness over time. So where you might see this, on your income statement within your 10K report, you'll see a line, an expense line called depreciation expense. The depreciation expense is the expensing out of the asset over time, over its usefulness. On the balance sheet, you'll see an account called accumulated depreciation. Accumulated depreciation is a contra account under the assets, under the fixed assets. It holds a negative balance under fixed assets. The idea here is that we are accumulating the depreciation without taking away the value of the asset. You see, that's why it shows up as a separate account on the balance sheet. We'd never want to take away directly from the asset. So the asset's value always maintains its acquisition cost. We don't subtract depreciation from that acquisition cost. We used accumulated depreciation as a contra account in order to allocate that depreciation. You see what I'm saying? You want to keep those separate. There's a couple of ways we go about computing depreciation. And I'm going to walk you through a few methods that we use in accounting for the allocation of depreciation. A couple of different methods that we use. And so the first thing I want to talk about are the factors that we use for computing depreciation expense. The first thing we need to do is identify the cost. What is the total cost of the asset? That's our acquisition cost. Purchase price plus, plus, plus. Our acquisition cost is going to end up being our book value or our cost of the asset. We also have what we call salvage value. Salvage value, as the name implies, it's residual value or scrap value. It's the estimate of the asset's value at the end of its useful life. So when we reach the end of its useful life, what's it worth? We call it scrap value, okay, or salvage value. This is the amount that the owner expects to receive from disposing the asset at the end of its useful life. If the asset is expected to be traded in on a newer asset, its salvage value is the expected trade-in value. So in business, sometimes we trade in equipment for newer equipment. So in that case, the trade-in value is going to be used as the salvage value. The third thing that we consider here in our calculation is called its useful life. This is how long we expect to use the asset, or how long it's supposed to live for, right? So to speak. Useful life of a planned asset is the length of time it is used in the company's operations. It's also called service life. It might not be as long as the asset's total productive life. For example, the productive life of a computer might be 8 years or more. Some companies, however, trade in older computers for newer ones every 2 years. In this case, the computers have a 2-year useful life, meaning the cost of these computers, less their expected trade-in values, is charged to the depreciation expense account over a 2-year period. I had mentioned that there are a couple of different methods that a company can use in order to depreciate the value of an asset. We have the straight line depreciation method, units of production method, and the double declining balance method. Depreciation methods are used to allocate the asset's cost over its useful life. Most frequently used method is the straight line depreciation method. The units of production method and the double declining balance method are also commonly used. The computations here that you see here at the bottom are reflective in manufacturing. So I wanted to provide you with a really simple example from a manufacturing company that produces athletic footwear. So a very, very simple example. We're going to use this data to show you how straight line units of production and double declining balance work. So here we have some information. And this is for a piece of machinery that the shoe company is looking to purchase. So here's the data that we have. We have the cost of the machinery, $10,000. The salvage value of the machinery, $1,000. Remember, salvage value is the value that it of the machinery at the end of its useful life, what we think it should be worth at the end of its useful life. The cost minus the salvage value gives us what we call our depreciable cost, the amount that we can depreciate over time. In this case, it's $9,000. We expect the piece of machinery to be used for 5 years. That's its useful life. And over that 5 years, the piece of machinery will produce 36,000 pairs of shoes. Okay? So, very simple example. So, using that information, we can calculate straight line units of production and the double declining balance methods. First, looking at straight line. Straight line is probably the absolute easiest method to compute. It's a straight line, right? In straight line depreciation, we're charging the same amount of expense to each year or each accounting period over the asset's useful life. It's a two-step process, very simple. The first thing we do is we compute the depreciable cost of the asset. This is also the cost to be depreciated. It's computed by subtracting the asset's salvage value from its total cost. So total cost minus salvage value gives us our depreciable cost. That's the first step. The second step is to divide that depreciable cost by its useful life. So in our very simple example, the total cost of the new piece of machinery is $10,000. We're subtracting out $1,000 salvage value to give us $9,000 depreciable cost. We divide the $9,000 by the useful life. In this example, 5 years useful life. So 9,000 divided by 5 means that we are going to have a depreciation expense and ultimately accumulated depreciation of $1,800 per year for the 5 years that the equipment will be in operation. And looking at that straight line method, we can see on our income statement every single year we have a depreciation expense of $1,800. It doesn't change on the income statement because we're depreciate the same amount every year for that 5 years. On our balance sheet, we have our accumulated depreciation. And the accumulated depreciation increases each year based off of the accumulation of the depreciation. So first year accumulated depreciation is going to be 1,800, and then we add in an additional 1,800 at the end of the second year. Same for the third year, fourth year, fifth year, until we get to a remaining value of the piece of machinery of $1,000, which is its scrap value. And looking at the schedule for the straight line depreciation, this just, again shows us very simply we are depreciating it by the same amount every year for the 5 years. So since it has a total depreciable cost of $9,000 and its expected life is 5 years, we know it's going to be $1,800 per year for that 5 years, which gives us a depreciation rate of 20% per year. Yeah, very straightforward. If we add up the depreciation expense for that 5 years, it equals the $9,000. That means it's been fully depreciated at the end of year 5. On the right side, we can see the accumulated depreciation. We're adding in $1,800 per year for that 5 years. By the end of year 5, the accumulated depreciation would read $9,000. So that is straight line depreciation. It's probably the most commonly used in business, and the reason for that is because it's the easiest. It's the easiest. So that's really the reason why it's probably the most commonly used. Uh, but I would also say that the second most commonly used is going to be double declining balance, which I'll show you here in a little bit. One of the other one of the other depreciation methods that I wanted to talk to you about today is the units of production method. When equipment uses the equipment use varies from year to year or period to period, the units of production depreciation method can be used to better match our expenses with our revenues. What we mean by that is we're measuring depreciation by its actual use. So the number of shoes that I make each year is not consistent. I make, maybe one year I might make 8,000, the next I might make five, the next I might be 7,000 pairs. You know, it varies from year to year. Very typical in a manufacturing setting. So, in order for us to better match our revenues with our expenses, we might use units of production method to do that. And this is another simple two-step process to compute the depreciation on a per unit basis. So the first thing we want to do is figure out the depreciation on a per unit basis as the asset's total cost minus its salvage value, and then divide by the number of units we expect to produce during the asset's useful life. Units of production can be expressed in the product or in the units, such as hours used or miles driven. So that's the first step. The second step is to compute the depreciation expense per period by multiplying the number of units produced in the year by the depreciation per unit. So again, very simple process. And using the same exact example we had before, we can do this computation. So the cost is 10,000 for the machine minus the salvage value of $1,000 equals a depreciable cost of 9,000. Useful life is 5 years. We expect to produce 36,000 pairs of shoes throughout the useful life of the asset over the 5 years. So for this company, we assume that 7,000 units were prepared during the first year, which is great. So we take the cost minus the salvage value to get us the depreciable cost of 9,000 divided by the 36,000 units over the useful life. That gives us about 25 cents per unit. So we take that 25 cents per unit and we multiply that by the actual number of units produced during that year. In this case, 7,000. That gives us a depreciation expense for the first year of $1,750. Looking at this from the perspective of a schedule, we can see that first year we did the 7,000 units, the following year 8,000, and then 9,000, and then 7,000, and then 5,000. Regardless of the number of units that we produce, we take that total number of units that we produce times the depreciation rate per unit to get our depreciation expense. Once we've reached the $9,000, that's when the asset is considered to be fully depreciated. And that just so happens to be at the end of year 5. But it's a pretty commonly used practice, especially in manufacturing. The third method I wanted to show you today is the double declining balance method. As the name implies, we are doubling the declining rate. It's an accelerated depreciation method, and it has more depreciation in the early years and less depreciation in the later years. The most common accelerated method of depreciation is the double declining balance method. We take the depreciation rate and we multiply that by the straight line rate. Common depreciation rate is the double of the straight line method. We call this a double declining balance. And we compute this really in 3 steps. The first step is to compute the asset's straight line depreciation rate. The second step is to double that rate. And the third is to compute the depreciation by multiplying that rate times the beginning book value. So very, very straightforward. To find the straight line rate, we take 100% and divide that by the asset's useful life. In this example, useful life is 5 years, so we take 100% divided by 5 years. That gives us 20%. That we then multiply that 20% by 2 to get to the double declining balance rate of 40%. We then take that double declining balance rate, 40%, and we multiply that by the beginning book value, $10,000, the cost of the asset. That means for the first year, we're going to have a depreciation expense of $4,000. Looking at the schedule for this, we follow that same process. So expense of $4,000 for that first year. That means I have $6,000 remaining to depreciate. So that the second year, we take that 6,000, multiply that by the 40% to get depreciation expense of $2,400. We add that $2,400 to the cumulative depreciation to get a book value of $3,600. We take the $3,600, multiply that by the 40% to get $1,440 depreciation expense. We add the $1,440 depreciation expense to the accumulated depreciation amount to get $7,840, giving us a remaining book value of $2,160. We follow that same process again. Take the $2,160 and multiply that by the 40% to get a depreciation expense of $864 in the fourth year. Add the $864 to the $7,840 accumulated depreciation to get $8,704, giving us a remaining book value of $12,096. Multiply that by the 40%. That gives us $296. We add that to the $8,704, giving us a cumulated depreciation of $9,000 at the end of year 5, which means we have a book value of $1,000, which is also the salvage value of the asset. Salvage value of the asset does not get depreciated. But that is the double declining balance method. Now you might be wondering, why might a company select double declining balance method over something like straight line or the units of production method? The answer in my mind is simple. Taxes, right? A company might want to use a double declining balance method for tax reasons, especially if the value of the asset is very high. And they want to reduce their taxable income from their income statement. They might select to use double declining balance method. What this does is it reduces their net income by the depreciation expense amount. So in my mind, the reason why a company might select double declining balance method is to limit their tax liability, especially during that first year. Yep. Here we can see a nice side-by-side comparison between the straight line method, units of production method, and double declining balance method from our example. And we can see what the overall impacts are from year to year. The majority of the companies use straight line depreciation method, and again, it's the easiest one, which is the reason why companies do it. Then they would probably use double declining balance or units of production, and then other accelerated methods. Oftentimes, it's never a straight, easy type of thing to compute. The reason for that is because in business, we don't always get to decide when we're going to purchase and implement a piece of machinery. It might happen at the beginning of the year, which would be great because I got the whole 12 months, right? But oftentimes it's not that straightforward. We might implement the asset and after Q1 or halfway through the year or three-fourths of the way through the year, whatever. So it's not always going to be perfectly aligned with our bookkeeping schedule. That's what I'm trying to say. So in that case, we use what's called partial year depreciation. When an asset's purchased or sold at a time other than the beginning or end of an accounting period, the depreciation is recorded for part of a year. And this part's, in my mind, somewhat simple because we can simply take that cost minus the salvage value divided by the useful life, and we can multiply that by the number of months, that it was in use for that first year, right? And what that does is it allows us to allocate on a monthly or quarterly basis. So that's why when you look through your 10K report and you look at the notes to the financial statement and you're looking at those fixed assets, property, plant, equipment, you it might make mention of the fact that we have partial year depreciation. We implemented this asset, in June of this past year, and therefore we have 6 months depreciation allocated to this year. So an important distinction to note for sure. And in some cases, we might need to make an adjustment to our depreciation. Depreciation is based on estimates of salvage value and useful life. There is some guidance from the Internal Revenue Service on how long things should be depreciated for or what their useful life is. However, there is some subjectivity involved here, so it's not an exact defined science behind depreciation. However, there is quite a bit of implied research application that we make for that depreciation expense, and there is a lot of guidance from the IRS on this. So sometimes there might be a change in the asset itself. Like for example, we put a brand new engine into a vehicle. And when something like that happens, we call that an extraordinary repair. And what that does is it extends the useful life of the vehicle, right? And so when something like that happens, we need to make adjustments to our depreciation schedule based off of that value added to the asset. So we'll talk a little bit about that. So when there are changes in estimates, we have to go back and make adjustments to our salvage value or the useful life or whatever the case might be. And that's what this shows us here. So this one's pretty straightforward because it's a straight line, but sometimes you might see revised salvage value, revised useful life, or revised book value in some cases too. So I just want you to be aware that these things do happen. There are other revenues and expenses and to be aware of when it comes to fixed assets. Fixed assets or plant assets require maintenance, repairs, and improvements. We have to decide whether to capitalize these expenses or just expense them out. When it comes to just simple expenditures, these are also called income statement expenses. They're costs that do not materially increase the value of the asset or its useful life. They're recorded as expenses. You'll see them on your income statement as repairs and maintenance expense. That's just, oh, we changed the oil on the vehicle. Changing the oil on the vehicle is not going to extend its useful life. You have to do it because it's a part of maintenance, but it's not going to extend its useful life. You're just doing preventative maintenance. And so that is just a simple expense, right? If you were overhauling the engine, replacing the engine in the vehicle, that would be a capital expenditure. Capital expenditures are often called balance sheet expenses, which are costs of the asset that provides benefit for longer than its current accounting period. They increase the asset and are reported on the balance sheet, right? So that's the best example I can give you is revenue expenditure is I changed the oil on the vehicle's engine. Capital expenditure is I replaced the engine on the vehicle. So that's the biggest difference between the two. This next slide, this really helps to summarize it as well, is with ordinary repairs, this is just repairs and maintenance, simple stuff. Maintaining operating condition, doesn't extend its useful life, doesn't increase any productivity. These are just expenses, of keeping the asset going. When it comes to improving the asset, we call these betterments and extraordinary repairs. These are major overhauls or are major part replacements, and they extend the useful life of the asset. So you might see these types of things also in the notes to the financial statements for your fixed assets. And at the end of the useful life of the asset, oftentimes the company will dispose of that asset. And they do this in a couple of real basic ways. They'll discard it, meaning bring it to the junkyard. They'll sell it, the asset, or they'll exchange it for a newer one, or yeah, exchange it for a newer one, upgrade it, if you will, whatever. Uh, but it's important to know that you'll find sometimes line items on your income statement and balance sheet, like especially on the income statement, you'll see something like the loss of asset or loss of an impaired asset or something along those lines. It simply means that it was discarded or it was sold below its market value. But is a part of the disposal of a plant asset. So just to be aware of that. When the asset is discarded, it could be either a gain, a loss, or no gain. If the sale is greater than its book value, it's a gain. If the sale is less than its book value, it's a loss. If it's equal to, there's no gain or loss. But it's just important to note that. Some of your companies might be involved in mineral mining or other earth material extraction type of businesses. These are oftentimes recorded on your balance sheet as natural resources, and these include expenditures necessary to acquire the natural resource and prepare it for its intended use. We call this depletion. Depletion is the process of allocating the cost of the natural resource to the period when it was consumed or when it is consumed. Natural resources are reported on the balance sheet at their cost minus the accumulated depletion. The depletion expense per period is usually based on the number of units extracted from cutting, mining, or pumping. This is similar to the units of production depletion. This is similar to units of production depreciation. And of course, there's methods that we use to determine the cost of depletion. and it's very similar to the units of production method for that we use for depreciation. We take the cost minus the salvage value divided by the total units of capacity. That gives us our depletion per unit, and we multiply that by the number of units extracted during the accounting period. Mining, cutting, or pumping natural resources require machinery, equipment, and buildings. When the usefulness of these plant assets is directly related to the depletion of the natural resource, their costs are depreciated using the units of production method in proportion to the depletion method. Just so you're aware of that. Some companies will also list on their balance sheet under assets, they'll have intangible assets. These are non-physical assets that can be used in operations to give the company long-term rights or competitive advantages. Examples of these include things like patents, copyrights, licenses, leaseholds, franchises, goodwill, trademarks, and right of use assets or leases. They lack physical substance and not always mean that may not always mean an intangible asset. Notes in accounts receivable, for example, lack physical substance, but they're not intangible. When a company acquires an intangible asset like a patent, copyright, franchise, trademark, goodwill, leasehold improvements, or other intangibles or research and development rights, we record these at cost and they are included in the purchase price, legal fees, and filing fees. So that's how we record an intangible asset. And you'll sometimes see that on your 10K report under fixed assets. A patent, as you may know, is an exclusive right guaranteed to the owner, to the manufacturer, and sell the patent item to use for the process for 20 years. So oftentimes a patent has a usefulness of 20 years. When the patent rights are purchased, the cost to acquire the rights is allocated to a patent account. What else can I tell you about this? Now, we also have copyrights. Copyrights gives the owners exclusive right to publish and sell things like music, literature, or artistic works during the useful life of the creator plus 70 years. Although the useful life of most copyrights is much shorter. And we amortize this over time. And then we also have things like franchises and licenses. These are rights that the company or a government grants an entity to sell the product or service under specified conditions. Most organizations, they just grant franchise and license rights. And then you might also see an account called goodwill on your balance sheet. Goodwill is the amount by which the company's value exceeds the value of the individual assets and liabilities. Sometimes a company will pay more than what the asset is actually worth for the use of that asset. And that difference, so if we pay more than its book value, that difference is called goodwill. Right? So it's just important to know what that is. And what else can I tell you? Oh, research and development is another thing that you'll probably see on your balance sheet. These expenditures are used to discover new products, processes, and knowledge. They are used to create patents, copyrights, and innovative products and services. Costs of research and development are expensed when they're incurred on the income statement, but they might have some implications on your balance sheet. And it's difficult to predict the future benefits of research and development, so that's why we're typically expense those out. And the last thing I want to talk about before we review the other content for the week is the total asset turnover. Now, I believe that it's the total fixed asset turnover ratio is what we're looking for in this week for your Excel file. So the way we're going to do that is we'll take our total sales or total revenue, and we're going to divide that by the average fixed assets, average total fixed assets. So when you're doing this, you're going to take your beginning balance fixed assets plus ending balance fixed assets divided by 2 to find the average. Uh, and that's also noted in the learning resources for this week. So as we look into this week, I want to quickly show you. Oh, it looks like I closed it out. Of course I did. Why wouldn't I close that out? I wanted to show you the. Let me just try to find the notebook. Yeah, we're in Unit 4. I wanted to quickly show you the template for this week. So a couple things to note here. Your company's going to have listed out their fixed assets, property, plant, and equipment, etc. There might be more than 3. Oftentimes there are. You're more than welcome to add some line items in here. What I want you to do is tell me what their depreciation method is. Do they use straight line, units of production, double declining balance? That will be noted in your 10K report, in the notes to the financial statements under fixed assets. You will see it there. It'll tell you for each fixed asset what method of depreciation that they're using. You'll find the cost of those assets. Those will be listed on your 10K report within the balance sheet. The cost of the assets. Uh, you'll see depreciation listed out within the notes to the financial statements. So there'll be the notes to your balance sheet under fixed assets. You'll see the estimated salvage values. Not everything's going to have a salvage value, but most do. If it doesn't, just enter 0. For the useful life, you'll also see that on your 10K report and the notes to the financial statements, how long the asset's expected to last, the useful life, which is one known number of years. And then you'll be able to calculate the depreciation expense from there. You can also find depreciation expense on your income statement within your 10K report. From there, you want to be able to calculate your fixed asset turnover ratio. You'll enter your total sales amount. You'll enter the fixed assets beginning balance, ending balance fixed assets. You'll calculate the average by taking beginning balance plus the ending balance divided by 2. And then you'll be able to calculate your fixed asset turnover by taking your net sales divided by your average fixed assets. And that'll help you to finish your template. And then once you're done with your template, of course, then you'll go into writing your executive summary. The executive summary, I also provided an updated template. Looks like this. And you'll go through and you'll do this for your company, just like you've done in the past few weeks. And that will round it out for you for this week. We also have, as you know, the discussion board for this week. Discussion board for this week, relatively straightforward. There's not a whole lot, nuanced in this week's discussion board. Essentially, I'm asking you to look at the differences between straight line depreciation and all the other methods. Discuss those differences, explore what your company's doing, discuss how it, all that type of stuff. Look at what's called the maker's report. This is generated typically by the Internal Revenue Service. It's a very specific model for depreciation. Just talk about what it is, right? Um, we'll talk about the difference between impairment and depreciation, international perspectives, choosing the right method. How do companies go about choosing straight line or double declining balance or the units of production method? And then any future trends that you find. So this will involve some research, of course. Obviously your 10K report definitely, but also outside the classroom, hop on the internet, do some searching to help you with that future parts, especially or anything else that you think you need help with. So that'll be your discussion board, and then of course you have the template and the executive summary. Are there any questions for those of you on the call? Oh, I see Justin. Justin, great question. A specific depreciation cost will be written on the balance sheet for every depreciated item value or on the 10K or both. So great question. It depends in your company's reporting standards. So some companies will have them separated out on the balance sheet. Say building, machinery, whatever, equipment, whatever. That sometimes it's separated out on your 10K on your balance sheet. Otherwise, sometimes the company will just consolidate that information and say fixed assets and then the full dollar amount. So in either case, you want to look in both areas. So I would look at the balance sheet and I would look at the notes to that balance sheet within the 10K report because you're going to find you'll find the obviously more detail in the notes to the 10K report. Um, so my recommendation in that case, Justin, is you know look through both, uh, and within the report itself, you'll find everything listed out. Now, that's a great question. You're welcome. Are there any other questions, comments, concerns?
Yeah. I'm just noticing I'm
Eric?
looking on my balance sheet, and they do break it down for land building improvements, machinery and equipment, and total property. And the notes give you some information. They tell you that all the costs are acquisition costs. They tell you that they give 30 years for buildings and improvements and
Mm.
3 to 15 for machinery and equipment. But they
Yep.
don't, there's nothing on salvage value, and the appreciate allow they tell you that it's all straight line, but they also just give a allowance for depreciation for everything. They don't break it down for
Okay.
each group.
Okay.
So how would I do that then with this spreadsheet when you've missing half the components?
Right. No, good, fair question. I'm surprised that the company wouldn't have listed out a little bit more of that detail. Um, because oftentimes they do. Here, let me see. Uh,
It's
Eric,
on page 31 in their spreadsheet.
page 31. All right, let me
Yeah.
let me pop open.
Or in their thing.
Let me see. First, let me find your link so that way I can get you checked out here.
Yeah.
Shepard, there you are. All right, Striker.
Yeah. So if you look at 31, they'll have a whole thing where it says property, base, and equipment. And that little thing above that too.
Yeah, excellent point. So usually the first place I look is always going to be on that balance sheet, and on the balance sheet, as you pointed out, I see land, buildings, and improvements, machinery and equipment, total PPE, which is your total fixed assets. So within there, if I go total PPE, and I can see a couple of things here. Examples include, oh, that's just the definition. Okay, subtopics, the accounting standards that they used, and I can see the statement. Okay, and then that tells me it's going to be in the notes. So then when I come down, to the notes, to the financial statements. Let's see where I'm looking for. So I see goodwill, which is great, but where are my fixed assets here? You said they were on page, I'm sorry, what page did you say they were on?
Page 31, 31.
31.
Mhm.
So let's scroll down to 31. Cost of sales, marketable securities.
There you go. Property, go up a little bit. You see
Yep,
property,
property,
plants, and
plant, and
equipment.
equipment. Yep, got it right here. Okay. And that's the footnote. So what I would do in this case, yep, so depreciation, they're computing by straight line. I will do a control F, and I'll go depreciation. And let's see exactly what else we can find. I see the depreciation expense, so that's, yep. I see cost of sales, research. They just give a lot of general information. Uh, Disposal of the assets. Okay, so hold on, let's see where all that's stemming from. And okay, depreciation and amortization. Let's see if I can. Some of these actually link all the way through, which is cool, but
Yeah, I'm learning each time we go the different things you can do.
so am I. Sometimes the structure of these reports are getting a lot better. Income tax.
Yeah.
That just brings it
Then
right back up. Oh, that's weird. Because they normally list out their assets. There's got to be a table somewhere. Let me see here. Assets held for sale. That's different. Fair value recognition. Let's take a look. Acquisitions, contingencies, intangible assets, capital stock, income tax. Surprise it. Oh, see what the impairment looks like. Uh, hmm, that's interesting. Well, it's going to make it more entertaining, I guess. Okay, so here, let's take a look. So for your situation, uh, because the problem is that got to find the cost of the assets.
yeah, nothing's broken down.
Yeah,
Well, that's not well, it's listed. Well, that's not true. The asset, each of the individual assets is listed at cost.
right.
And
Which
then but the depreciation, I can do that, but I can't do any, can't separate out any depreciations. And
right.
again, they just give a range, so you can't calculate if it's a 3 to 15
Even if we, yeah,
year salvage value.
well, even if we, worst case scenario is we use the for useful life, we use the full 15 years,
Yeah,
you know, and then I think that would probably end up being the way that you'll have to do it for your situation. That part's
yeah,
weird. I'm really shocked that they don't list them
yeah.
out.
And then I can just, I guess, and for anybody else who's in the same boat, I can say assume a salvage value of 10% or something like that, just to make the math work.
Yeah, exactly. Yeah, and that would work. Yeah, interesting. Wow. Hmm. You know what? Maybe on their investor, even the investor relations page, I don't know, would show that type of detail.
Yeah, probably not what the investors are that interested in.
Right, right, exactly.
Why
Hmm.
would they not show that?
It depends on so they could show that, and then most of them do. The reason why they might not is to simplify the reporting. I mean, that's the only real reason I could think of that they wouldn't.
But I
'Cause
think
go ahead.
But for a big company like this that's got manufacturing plants all over the world purchased at different times and different periods within their useful life, I would think it would be an incredible amount of reporting in detail that they
Definitely.
just have lumped together to make easier.
Yeah, that is exactly right. That's probably the real reason why they did that.
That's interesting.
Yeah, it sure is. Yeah.
Yeah.
Yeah. Always fun. This part's always entertaining to me anyway. Cool.
But better to
Great.
address it up front than on the back end.
Yeah, yeah, 100%. Yeah, definitely. Any other comments, questions, concerns?
Yeah, in my own case,
Yeah.
the machinery and equipment are grouped together.
Yeah, yeah, that's very common. Yeah, it's very common to group together. In that case, it's fine to delete one of those lines or to change one of those lines if they're grouped together.
Okay. Thank you.
But just make sure that as you're reading through the report, um, to see if they're not separated out somewhere else.
Okay.
Like in the notes to the financial statements, it might be separated out there.
All right. I just looked in the notes. That's where I saw, because in the balance sheet that we have property, equipment, and machinery together, but in the notes we have machinery, equipment together, and then we have lands, buildings separately.
Okay, got it.
Yeah.
Yeah, yeah. So in that case, if they're grouped together, just group them together on the spreadsheet.
Okay.
Yeah, great question. Awesome. Any other comments, questions, or concerns that I could help to answer? All right, cool.
Well, thank
Okay.
you very much.
Yeah, no, thank you all. I appreciate your time. This is always good. It's always good to get together and be able to talk to you all. Um, it, Justin, yeah, that's a good point. Maybe if they reported the details would be unflattering. Yeah, well, yeah, you never know. The law dictates that they're required to disclose as much as they can, but even if it is unflattering, but sometimes they just group it together just for simplicity's sake. Good point. Okay, great. So thank you all so much for your time today. I really appreciate it. If you need anything in the meanwhile, just feel free to shoot me a quick email or a message or whatever, and I'll be happy to get back to you. But thank you again,
Thank
and
you.
look forward to the next one. All right,
Thank you
take care,
Yes,
much.
sir.
y'all.
Bye.
Thanks. Bye bye.